Matt, is it pronounced Iles?
Yes.
Yeah,
Awesome.
farmer insurance agent. Actually, Jennifer suggested we talk to him, and he is trying to push for some new laws and regulations regarding fire insurance. There's a world of that you should know. This is KFI AM 640. Good morning. Handel here on a Friday, May 10th. The big stories that we're covering, the Newsom budget. And he has just come in with his proposed budget, the final one. China tariffs, big news. President announced yesterday a whole new slew of China tariffs against Chinese goods. And the stock market yesterday went down pretty substantially, and it's down 300 points right now. So there's reaction, big reaction to it. All right, now. The issue of home insurance, and there's a fair amount of controversy after the fires, of course, when thousands of homes went up in flames. And one of the topics that came as a result of those fires, of discussing those fires, was the issue of home insurance, fire insurance. Well, there's a gentleman by the name of Matt Iles, who's a farmer's insurance agent, who is up to his eyeballs, not only in terms of selling insurance, but trying to get the state legislature to recognize some of the big issues. Matt, thanks so much for joining us.
Hi, how are you, sir?
I am good. So I know that you want to go to the legislature. You've written a letter. You want to change things around. So let's talk about first the problems that we have right now, what's wrong with the system, and what you want to change it so it works.
Sure. So the traditional insurance market there's three parts to it. There's the admitted market, which is the major insurance companies you know. They're regulated by the state, and those insurance companies basically are the ones you've heard of: Farmers, State Farm, Allstate. Our rates are regulated, and in turn, there's a guarantee fund that makes sure that if we go bankrupt, our claims are paid by the state, solvency program. So there's actually an insurance company that went bankrupt out of the Camp Fire, and out of that, people had about 30 days to get insurance because their insurance policy was gone, and those that had their home burned down, they can step into, filing a claim with that guarantee fund.
Now, is there enough money to pay for all of that?
Honestly, the guarantee fund is been around for a very long time. It's rare that insurance companies actually go bankrupt, but with this brave new world of fires destroying 16,000 homes in a fire, I don't know how long the rate that they're charging the insurance companies for the guarantee fund is going to stay solvent. If they have enough money, I don't know where the state's money goes there.
Right.
I don't know.
So there's a potential that goes under also.
Sure. So, the secondary part of the market is the non-admitted market, and that's companies that you've heard of like Lloyd's of London, Scottsdale, Hippo. And those insurance companies, they don't participate in the state guarantee fund. So there's an unusual risk there where obviously those are large companies and they have reinsurance, but they could go bankrupt and then there is nowhere to go. So if your policy actually cancels, you cannot file with the state guarantee fund. You're sitting at bankruptcy court, with your hand out, hoping that you get a piece of that company as it gets dissolved.
Now, if let's say you have an uninsured a company that isn't regulated, for example, Hippo, which I have and probably will keep on doing commercials. What makes so that's a disclaimer here, but the assets behind Hippo, about $200-300 billion,
sure.
major companies. So if that company goes under, our economy is gone, isn't it?
Well, I don't know, because I've seen that advertisement, and Hippo would have to comment on that, but I don't know if that $200-300 billion represents the reinsurance or if that's the people that have invested in them as, A shareholders or C shareholders. I don't know what.
All right,
that
we're getting into the weeds here, and I apologize for that.
Sure.
All right, so you have those two kinds of insurance companies: those that are regulated, that are part of this fund, and those that are non-regulated, that are not part of this fund.
Correct. And then there's a third. It's the California Fair Plan, and it's made up. It was born out of legislation in the 60s when there were brush fires and riots in California, and people that couldn't get insurance. There's a California insurance code. The insurance commissioner has direct authority over it, and it's basically an association of the insurance companies. It's a separate risk pool. Because insurance is a risk pool. Each individual insurance company is a group of people. It's a group of members. We all throw money into the pot for the poor soul or town that burns down. Okay, and so the California Fair Plan is when a particular pool of insurance, it gets to where it has too much risk, and they cannot maintain the number of clients that they have in risky areas. So they send their customers to the California Fair Plan, and the California Fair Plan is a place where the losses and the profits, if there are any, are shared among the insurance companies. They're assessed, their share of it if the pool is insolvent.
All right, so I'm assuming that's probably the safest insurance plan you can get, because it's all the insurance companies that are regulated, I'm assuming, being part of that.
Sure. It's safer in the sense that there are several backstops to make sure that it doesn't get depleted. The frowning upon the Fair Plan is mostly in regards to what it covers in terms of perils and what coverages it either has or lacks.
All right, let me put you on hold. I got to take a break. Do you mind hanging on, doing one more segment with me?
No problem.
All right, we'll be right back with Matt Iles, farmer insurance agent, who is discussing the various plans and wants some changes, is getting involved with the California legislature. So we'll be back with that. In the meantime, there's... All right, back we go again to Matt Iles, farmer insurance agent extraordinaire, helping us out understand insurance and what the state can do, who is involved in trying to get the state to figure out how good insurance works in California because of the fires and how they just wiped out so many homes. And Matt, just to reintroduce you and the policies you're talking about, we had three different kinds of insurance: regulated insurance policy, state farm, etc., farmers insurance like yours, non-regulated, which are not controlled by the insurance commissioner, and then the fair plan, which all the insurance companies kick into, where there's different higher kinds of risk. I'm assuming high risk areas, high fire areas that insurance companies for the most part want to stay away from. Those people go into the fair plan. Is that fair to say?
Yeah, I mean, so basically the market's been pretty rocked. They haven't anticipated fires like this before. So, I mean, these are literal fire tornadoes that, I mean, when I was here where I'm at, I'm near the Carr fire. It looks like Mordor. I mean, when the fire's going, it's that tall of flames. It's insane. So they didn't anticipate this kind of destruction, but yeah, they can't afford it. They have a fiduciary responsibility to make sure that those pools of consumer money are solvent. And if they continue to take people in these areas that have a existential threat, they threaten all of everybody's premium dollars.
So let me ask you, now you're involved in trying to change the structure. What should be done in your opinion?
So if you look in the past, there have been times when we've faced this kind of, whether it's floods or earthquakes or other kinds of perils. Wildfire as a singular peril, we know how much we collect for wildfire at each individual admitted insurance company. What I want them to do is I want them to pool, but still the regular admitted insurance companies administer the policy, administer the claim. So I want them to pool that premium dollar that you pay for wildfire into a larger pot of money. So the insurance company that you like, that you deal with, your agent, your adjuster, you still get them in that claim. But that premium dollar is pooled and more solvent when everyone's premium dollar is shared at the same pot of money.
Sounds like a national health plan for fires in California. Do I have that right?
Not quite. So in the state of California, we have what's called the California Earthquake Authority, and we did that out of solvency issues for individual insurance companies. There's a singular peril that can happen, and when it happens, if one insurance company has too much of the risk, they just go bankrupt.
All right, so I have earthquake insurance, and I don't remember which company I have, but it's not with that insurance company. You're telling me that risk is spread?
So the California Earthquake Authority is where all the admitted insurance companies, they send their clients to. We administer the policy for the clients, but the actual fund itself is a separate entity. It's not the state. The Fair Plan is not the state. Just like state workers' compensation insurance fund is not the state. It's a separate enterprise.
Okay, so that's what you want to do. You want to take the earthquake...
That singular peril.
Right.
Because the major hiccup here is you have whole areas of the state that their property values are devaluing. People can't get insurance. It becomes a disclosure issue in real estate contracts. These homes are losing their value, and it's just even a 3 or 4 month issue that's just popped up out of nowhere.
Now, are you getting any cooperation from state legislators, or this is early days?
There's a few legislators that I've been texting with, talking to, and they've been very responsive. I mean, obviously, those that are affected by the Camp Fire and Car Fire are the ones that are talking to me, because they're getting so many complaints now in terms of, I've lost my insurance, I can't sell my home because my home is uninsurable. And you can imagine no one wants to buy a house if the regular insurance policy was $1,000 one year, and then the next year with the Fair Plan and a wraparound policy to cover what the Fair Plan does not cover. When you go that combination, you might be $5,000 a year now instead of $1,000. Now it makes a home unaffordable to buy.
Yeah, for sure. Yeah. Now the insurance, the insurance companies that were affected the most by these wildfires, I'm assuming they lost their shirts on this stuff.
Sure. I mean, they're collecting from their reinsurance policies, but you can imagine as a reinsurer, you don't really want to offer a policy for a catastrophe in California next year, do you?
And real quickly, of course not. Real quickly before you leave, would you tell us what a reinsurance plan is?
So reinsurance is basically insurance for an insurance company. So when a catastrophe occurs, they can collect from that. But that reinsurance pool, I mean, obviously is getting depleted too. We haven't too many of these fires.
All right. So so effectively, insurance companies pay premiums to their insurance companies. That's the reinsurers. All right. All right. Thanks for spending time with us. That helped a lot. All right. Matt Iles, Farmers Insurance Agent. Thank you, sir. Greatly appreciated. Coming up, Handel on the News, late edition, and it's a super segment.